stay in your corporate job and build these things, whatever you want to do, your side hustle, start investing, do that on the side. There's a lot of gurus out there that say, burn the ships, quit your job, and I don't agree on that. Take that money and invest it in cash flowing assets and build up that cash flow to at one point, you're going to feel comfortable to leave corporate work.
Welcome, everyone, to the Road Less Traveled Show. This is a show about people that were successful in a previous career and left that career to go down a different path. I'm your co-host, Richard Coyne.
And I'm your co-host, Bill Zahller.
On today's show, we're so pleased to have Marco Pfeiffer with us. Marco, welcome.
Hey, thanks for having me. Appreciate it.
Absolutely, Marco. Well, thank you again for being on the Road Less Traveled Show. To start with, can you tell our listeners a little about your background, what career you started in, how long you were in that line of work?
Yeah, so originally I'm from Germany. So I immigrated to the US back in 2002 and started as a financial analyst working for a German company. And that company went bankrupt back in 2005. So I had to look for a new job. So I learned the hard way that you cannot depend on your W-2. However, at the time I chose corporate as my career path. So I advanced my corporate career back in 2010. I became a CFO of about $140 million company at the time, and was a CFO for the most part of the last 10 years of my career. So along the way, I discovered real estate, started investing in real estate. What really drove it was in 2016, I was unemployed for about 3-4 months. The company I was a CFO for had financial problems, they downsized, and ultimately the company went bankrupt. So I realized even though I had savings, even though I was doing well as a CFO, I realized I don't have that cash coming in. So at one point, those savings will be depleted. So I looked for ways to build that cash flow. And initially the goal was just if I get ever unemployed again, I have, I don't know, $3,000, $4,000, $5,000 coming in every month. So I'm not worried about it. I can take my time, find something else, and I don't have the stress of, how do I pay the mortgage? And from there it took off, the snowball effect kicked in. So I kept buying rental properties. And in 2020, I was generating more income in real estate than in my CFO job. And I decided to leave the corporate world at 45 years old. And since then, solely focus on real estate.
Great. What type of assets did you start buying? Were they single family, fourplexes, larger? What the progression along that was, and kind of what areas are you looking at?
Yeah, I started with single family. So I actually, from an early point on, I diversified. So I lived in Huntsville, Alabama in 2016, and I started buying there. But I also started buying in Fort Myers, Florida. And from there, since then, right now I'm in 4 states. So I still invest in Alabama, mostly in the southern part of Mobile. Invest in Mississippi, Georgia, and in Florida. Those are the 4 states I'm focused on. Like I said, mostly single family. So by now I have a portfolio of about almost 50 single family homes.
Nice.
Along the way, I discovered multifamily. So I started buying 4-plex. Next thing I bought was a 12-plex, and did very well with those. And then in 2020, I joined with a business partner, and we created a joint venture, and we started buying apartment buildings. So at one point, I owned about 150 units in a joint venture, and they were all in the South Alabama, South Mississippi area.
Okay.
Excellent. Yeah.
Wow. Very good. Very nice. Very nice. So, Marco, as you look back to your corporate days, maybe as CFO or one of your other roles previous, is there a funny story you can share?
Funny story. There are plenty of stories. If you give me a certain topic, I'm sure I have a funny story for it.
Just anything.
It's just. In corporate, it's one of the things is one of the reasons I'm not in corporate anymore is I felt like there were a lot of I call them Teflon people. They don't like to make a decision They just cruise along, Some of them are managers and they just sit there, avoid to make any decisions so they don't get in trouble, don't do anything wrong, and just cruise along, So I had plenty of encounters with those. And that's one of the reasons I just did not like being in corporate anymore. I don't have a specific funny story right now I'll back my head, but I mean, it's just there were um, so many little things where you look back in hindsight and you kind of reflect on, you kind of shake your head. I mean, at one point I was CFO of a company, and the CEO he got backstepped. It was basically a joint venture, so two companies merged. The CEO or the owner of one company, he stayed on as CFO of both companies, and the management of the other company somehow despised that not their owner, not their CEO became the CEO of the whole company, and they were kind of undermining him, backstepping him. So ultimately, over time, he removed those people. But what he did, he surrounded himself with yes-sayers. So he just made sure that everybody around him is aligned with him and has the same opinion. And so so when we sit in executive meetings, usually it went the way. And I'm making up a hypothetical example. I want to get that somehow back. But so for instance, we sit in these meetings and he come up with the idea. This was in the South, so it's like, hey, and we had business in refineries and in chemical plants. So let's say he came up with the idea and said, I think we should get into the ice cream business. So let's because we're all in these refineries. It's hot in the summertime. If we're bringing ice, we have these technicians going out there. We're bringing an ice cream truck with us. I'm sure people are going to buy those ice creams like crazy. And they're all like VP of sales, VP of operations. They're like, yeah, that's a great idea. That's a great idea. We should do that. And I'm sitting here. I'm like, I think we should get in the ice cream business. That's not really what we're doing. It's not. I mean, yes, we can make some money, but I don't think we should lose. And they're all like, "Oh no, you're the bean counter. You're the finance guy. You have no vision, no creativity." And the CEO, he would sit there and he's like, Marco, I think you're right. I don't think we should get in the ice cream business. And they all were like, yeah, absolutely. No, we shouldn't get in the ice cream business, And and this is how these meetings went. And there was one point I was like, this is just stupid, It's just
That is
but
funny.
That's what happens, I saw that a lot in the corporate world.
Oh yeah, I completely have seen ridiculous situations like that a million times in the corporate world when I was in the corporate world. I mean, even way back when I was really I was in college, I had a summer job, and even though it was government and even though I wasn't officially fully employed, I did get a little taste of the ridiculousness of large organizations. There was a particular situation where, the number two guy, I was talking to him and I asked him how to do this particular project. What are they looking for? What are you trying to get to? And he replied, well, it doesn't matter what I think. It matters what the boss thinks. I was like, oh, okay. Well, then what do you think he wants? He said, well, you know what? Sometimes we have no idea what he wants. So sometimes the best thing to do is to come up with the most ridiculous, crazy idea and present it to him. And then he'll say, oh, no, this is what I want. And then he'll tell you what he wants. So I'm like, you gotta be kidding me. You gotta be kidding me.
No, it's so much waste in corporate America too. Not only corporate, it's corporate in general. I mean, I used to work in Germany, and I worked on projects in Germany, and I worked on projects all over the world. So it's probably something I saw all over the world. It's just there's so much waste, so many meetings, talking, you're going in circles. My favorite meetings are the meetings you sit there for like 3 or 4 hours, and then the only tangible outcome was, let's have a follow-up meeting.
Right.
Right. Okay, what are we talking about for the last 2 hours?
Right. And it's government, it's corporate. I think again, anytime an organization gets to be a certain size, it has to justify its own existence by having more layers and more people, and then with that becomes more levels of indecision. And like you said, nothing drives me crazier than getting to the end of a meeting and having zero results.
Yeah. And I think you hit the nail on the head. Is there's these corporations, they blow up, and then suddenly everybody has to justify their position.
Right.
They all have to yeah. justify why they're there and what their role is and why they're important. And they all have to have a saying in it, it has to be a
Yep.
joint decision. But next thing you know, there's like 15 people who have to have to comment on it whatsoever.
Yeah.
Was once in the. I mean, now that I'm talking to you, I get all these stories. I get these flashbacks right now.
Scary flashbacks,
And
right?
I was one the controller, and then we had this organization within. They were their whole focus was finding cost savings, and they came up with all these things. And then we had a plant in Huntsville, Alabama, which was struggling a lot, and ultimately had to close down. And it was humongous. But at one point, it was $1 billion in revenue in that one plant. And so these guys, they go out, they find all these cost savings and all these things, and try to save the plant whatsoever. So we have a meeting, and then they show they've saved, like, I don't know, I'm making up a number, $30 million. And I'm like, okay, where do I see, as a finance guy, so where do I see in the P&L your $30 million savings? Oh, well, a lot of it is cost avoidance.
Right.
So what? Yeah, because we did this, and this, so we didn't have to spend the money. So it was cost avoidance. Well,
So if you didn't actually spend it, then you didn't actually
but that's how
save
they
it.
justified their position. They had these nice big meetings, and they come walk in there and like, we saved $30 million. And then when you looked at it, you try to somehow reconcile that as a finance guy, like, there's no $30 million. And it's like, yeah, it was like 80% of it was cost avoidance.
Right.
It's always like when I always have the sales and everybody goes shopping at the sales, like, look at all the money I saved. Well, really, you spent a lot more, but you may have saved a fraction of whatever the markup was. Right. Yeah. It's I guess if you didn't buy a yacht today, you saved $100 million. That's great. Didn't really have it, but so Mark, what was the kind of deciding factor getting you leaving corporate America? You mentioned once the kind of the wake up call that once your income went away, it wasn't a sustainable path. Was that the main, just financial security was kind of the main driver? Or?
Yeah, it was the dependence on the W-2. I hated the feeling. At the time, I was married. We just bought a new house. We were selling the house we lived in. And 1 week after I got unemployed, the house fell out of contract. So I was stuck with two mortgages. My ex-wife, she was still working, so we were not starving or anything, but it was really a squeezy feeling in my stomach. Where I'm like, this is now you're stuck. And this was Houston, Texas, so we were good sized mortgages, both of them. And and I just didn't like the feeling. I hated the feeling. And to be honest, that feeling is still what drives me today. That feeling of being kind of helpless, kind of like, okay, now I don't have this every 2 weeks, this money coming in, and yes, I have some savings, but if I go on this rate, at one point, these savings are going to be depleted. And so yeah, that's what really drove me. It was not necessarily, I was still at the time, was still kind of on the corporate career. I want to be a CFO, be CFO of a bigger, because the way you're CFO, so what's the next step? You want to be CFO of a bigger corporation. That's kind of like at the top of the food chain. So the only growth you have now is becoming a CFO of a bigger corporation. And at the time I was still on that track, but in my mind, I also wanted to have some kind of security, like having $3,000, $4,000, $5,000 coming in, cash flow, rental income. And this would give kind of the peace of mind and kind of be less stressed if I ever get let go again, and for in everything in hindsight, it was a blessing in disguise, so for 3 months, I could really focus on real estate. I really went all in. I got some coaching. I went to network meetings. I read books, listened to podcasts. So I was really for 3 months going all in, which I could have not done if I had still worked at the time. So in hindsight, it was a blessing in disguise, and it got me on that track. And then from there, like I said, it snowballed. So you buy your first property. Now there's $200, $300, $400 coming in. It's nice, but it's not life changing. Not next thing you know, you got 10 properties. Now you have $4,000 coming in. And like, okay, you're still at one point I got deployed again, so I had my income, my ex-wife's income, and plus on top I get now $4,000 in cash flow coming in.
Yep.
So kind of the snowball effect kicks in. You're like, I like this, and I like the feeling of it, and I enjoy real estate. And what I did mostly was buying distressed properties, distressed houses, fix them up, and rent them, and then refinance them at one point at a higher value. And to
Yeah.
kind of take the money, recycle it, feed the next investment. And yeah, so within 5 years, when I retired, I was about 23 rental properties. And
Nice.
so yeah, so it was yeah, yeah, that was my main driver, was being unemployed and that squeezy feeling in my stomach. And that's what kind of, I mean, it's not easy. I mean, you work 60 hours as a CFO, and then on top you start looking at properties, you go to on weekends, you go to these networking conferences, real estate conferences, all of a sudden. It's time consuming, it's hard. But what really drove me the whole time was that's reminding myself of that squeezy feeling in my stomach,
Right.
and to be honest, it was worth it. 5 years later, now, I mean, I live a life by design now. So I travel a lot. I did a road trip to Cabo, Mexico earlier this year. Stayed in Cabo for 2 months. Took my two dogs with me.
Nice.
It's just things you can do now. You have that freedom with that cash flow coming in, passive income, semi-passive. I mean, there's still some work involved. It's not all passive, but semi-passive income coming in allows me to live a life of design, to do things that are really, really important for me.
Nice. Marco, when you first were getting started, you mentioned obviously time was a dimension, given that you were working full time. When you got back into the workforce, you were working full time as well as trying to do real estate. What are some other obstacles you had to overcome that you can mention?
I mean, one is limiting beliefs. I mean, the number one obstacle I think is limiting beliefs. It's um, can I really do this? Is this really possible? I mean, there's all these horror stories about real estate, and I heard plenty of them. Um, don't leverage too much. Be careful with this. You have all these tenants that destroy your house. You get the call at 3 in the morning with the toilet not working, and all these horror stories. And it's a lot of these limiting beliefs, I think, or not limiting, scaring, but also there's limiting beliefs like, can I really do this? Is this really possible?
Mm-hmm.
And to be honest, what kind of helped me was my story of being an immigrant and coming to the US. When I came to the US, I literally, it's like the American cliche, but it really was American dream. I came with, I think it was like $1,500 in my pocket. I'd never been to the US. I didn't know anybody in the US. I barely spoke English. So I had to build the life. I mean, yes, I had a job, but that's the only thing I had. I had to find my own apartment. I had to find my car. I was really on my own. And building this life, I realized if I put my mind to it, there's nothing I cannot do.
Yeah.
And then that was the same with real estate. When I really put my mind to it, this is what I want to do. And when I realized after like 6, 7, 8 houses, like, hey, if I go on this path at one point, my dream was always to retire at 55. It's like, if I make enough money, if I save up enough, put enough money in the stock market, hopefully at 55 I can retire. And then you're at 42 and you're like, wait a minute, if I keep going on this path, I might be able to do it earlier. And
Nice. Yeah.
And so I think one big obstacle is limiting beliefs. Time is one. You just have, and it comes with mindset. Are you willing to do what it takes? And most people are not. Everybody's like, and I've encountered so many people like, oh, I love what you do. I would love to own some houses. I want to do the same thing. And then you talk to them, you kind of explain what you do and how you get there, and then you lose you lose a lot of people. It's like, oh no, I don't have time for that. I don't have time for this and all that. Okay, it's fine, and I don't judge. I mean, it's fine. It's just you can't. I mean, it's one of you have to kind of decide what you do, how you allocate the time and your energy and your resources.
Yeah. Some people think, it's an overnight boom. All of a sudden you got $1 million in the bank because you're a real estate investor. No, it takes time. I mean, again, it time and effort. And again, it's rewarding and you can absolutely achieve. There's no limit to what you can achieve. But at the same point in time, you got to put some work in. It doesn't just happen with like flipping a light switch. So
real estate is a long game. Okay, it's not a get rich quick scheme,
Right.
and that's what a lot of people. And here's the other problem: we live in a time of instant gratification. Everybody's like, "Oh, I'm gonna buy some Doge coins, and next thing you know, I have $2 million." It just goes like this. We live in a time of instant gratification, and people are so wired. Like, you want to buy some stocks, and it goes up 50% within a week or something, and that's not real estate. It's a slow grind. At one point, as you get scale, it accelerates. But in the beginning, it's a slow grind, and a lot of people don't realize it. Yes, it looks nice now. I own my time. I can go to Mexico for 2 months. And yeah, that sounds all great and all that, but there's a lot of work that went into to be in this position. In my opinion, it was worth it, but it was work that really got me there.
Yeah, it's good to go in with your eyes wide open. Like I said, if you're sharing that with the next person, that they, and they can see it's achievable because they can see your path through it, but also there's to understand the work behind it. It's not just a passive endeavor. Throw a few dollars here and it takes care of itself and just grows, sends money every month. Well, Mark, what was one of the your first victories? It could be either the first house you closed, or it could be, like you said, maybe you're in house number 7 when you realized you could achieve maybe early retirement, or kind of what sticks in your mind as a first victory that really solidified the fact that this is a path for you.
One thing that really shapes me even today is actually my first rental property. And when I say I started in 2016, I was actually an accidental landlord in 2009. So I had my first rental in 2000. No, it's straight back 2000. Yeah, 2009. So I lived in Huntsville at that time, then moved away, and the house I lived in, I turned that into rental. And at the time, my mortgage was like $1,160, and I rented for $1,200. And I was happy that now somebody pays my mortgage. Unfortunately, at the time, I didn't understand the whole concept of scaling up and whatsoever. However, I learned a lot from that property. So that property I bought in June 2008 for $180,000. I mean, if you pick a time to buy a house in the last 20 years, June 2008 was probably one of the worst times to buy a house, and so I bought for 180. By 2010, the house was worth about 130. However, I didn't care because I didn't really need the money. I didn't have to sell, and somebody paid my mortgage. So that kind of clicked in my head. It's like, okay, if I don't have to sell and I believe in real estate, we'll recover at one point, things going to be okay. And well, that house today got appraised last year for $330,000 and has been rented since 2009. There were about 20 days it was vacant since 2009. And the rent that was $1,200 back then is $1,900 now. So it really showed me the power, and I have refinanced that house twice since. So as the equity went up, I refinanced. As equity went back up, and I paid down the principal, I refinanced. So I refinanced twice on that house now, pulled out a substantial amount of cash, and cash flow even today, after 2 refinances, still cash flow on that probably $400. And so that was probably one of the lessons where, and it's kind of, and apply that to today, when there's a lot of talks about the real estate crisis and upcoming crash, and people talk about that for 2 years now, so multifamily, yes, but multifamily is measured differently. Multifamily, you have cap rates and interest rates kind of go into the equation. But if you just look at single family, there hasn't really been a crash yet. But even if there was, for me, it's like, as long as I cash flow, I'm going to be okay. Yes, interest rates are 8%, and maybe that's going to impact the market, and it's going to drop in 2024. But if I cash flow, even if the value of my house drops 20, 30, $40,000, I'm still, and I don't have to sell, I'm still going to be okay. And if I
Right.
believe in real estate in the long run, that I cannot tell you what my house is worth next year. I have no idea. It might drop in value, but I'm 100% confident in 10 years from now, that house is worth more than it's today.
That's right.
So if I look at it from a long-term perspective, if it fluctuates down 20, $30,000, it's not, and I don't have to sell and I still cash flow, it's not gonna impact my investment decision,
Yeah.
And so
Like
that's kind of what I learned from that one house.
Yeah. So, well, even in that example, like you said, that if you bought it at 180, it went down to 130, went back up to 330. I mean, you've got 150,000 in equity or so in it, and whatever you pulled back out in the refinances, now your return, I'm sure it was more than you put down. So your return on that investment is infinite. I mean, whatever it's
Yeah, no,
returning.
it's infinite. It's infinite returns beyond. I mean, I don't have the exact number in front of me what I pull out, but it's substantially more than what I put in. And like I said,
Sure.
it was rented since 2009, so I haven't really paid a mortgage since 2009. So somebody else paid that mortgage for me since 2009. Plus, yes, in the beginning it was $40, but it grew over time, as the rent went up. And and yeah, so it's if I calculate all the cash flow I made, all the refinance, I mean, it's looking back in hindsight, it's probably one of my top three investments I ever made.
That's
But at
great.
the time, like in 2010, it didn't feel like it. It's like you
Yeah.
buy something for 180, it's worth 130. It doesn't feel like it. But
Yeah.
then if you have the long-term perspective, you look back 15 years later, 14 years later, then it actually turned out to be a really good investment.
I know somebody who bought a house that was a really nice house. It was I don't know the time frame, but I'm gonna darn well bet it was probably in late 2000s, probably 2008, and they paid top dollar for the house. Just say they paid 375 for the house. Somebody else came along and bought a foreclosure 4 doors down, like 2 years later for half price. I mean, that just makes you sick, but that is how
Yeah.
bad the housing crisis was in 08, 09, 010 and all that. But, again, I think, like you said, our market fundamentals are much, much better now in terms of the housing market than they were.
And this is
So,
when
yeah,
people are like, oh, this is going to be 2008 all over again.
no,
Everybody who tells me that, it's like, if you think that 2023 is going to be like 2008, you do not understand 2008.
right,
You do not understand what
right.
drove 2008. If you really think that, okay, it was
Yeah,
a very different market. Okay, one of the reasons it crashed was there was an oversupply. There were too many houses.
hmm
Okay, we're in a total different market now.
right,
We're in short in supply. Okay,
right.
the time from 2010 to 2020, the least homes were built in 70 years in one decade between
Yep,
2010 and 2020.
yep,
Okay, so at the same time you got the millennials coming into the market, which is the people don't realize it's actually the biggest size of any generation, even bigger than the baby boomers is the millennials.
sure,
So now they're coming into the market, and you're building less houses. So plus the whole criteria of getting a mortgage back then, I mean, if you had a pulse, you got a mortgage,
right.
and
I love
and
that.
today you have to jump through all these hoops. I mean, go try to get a mortgage right now. You have to bank statements. I mean, it's almost like colonoscopy, to get a mortgage today. So
I love that.
so it's
Yeah, I love that in the
so
in the movie The Big Short, where Mark Baum is down in Florida and he's talking to a stripper, and she says something about what do you mean my mortgage adjusts? And he says yeah, and he says, oh well, that's a problem. Is it just this house? And anyway, she wound up having 5 houses because she didn't have to prove with the ninja loans. It was
I encourage
ridiculous.
everyone. I encourage everyone watching The Big Short. I've watched that movie probably 15 times at
Yeah,
least in my life.
yeah,
It's on many levels. It shows you it's actually influenced my investment and my investment fees and the way I look at investment. That movie influenced a lot. As one is you see the boom and how people do crazy things. They don't question anything. They just
right,
do it like, oh, it's going to work forever.
right,
It's going to work forever magically. It's all going to work forever. When he meets this guy in Vegas, at the where he does all these these mortgage-backed securities and stuff, and he's like, "This is what I do. We're just selling this and selling this and selling this, and we don't even think about it,
Swap this and securitize that and swap it
like
again.
derivative of the derivative,
Exactly.
We bundle up junk and it becomes A.
Yeah. A plus. Moody's. Thanks, Moody's.
No, and this movie is really, it really shaped me. And then like the scene what you just described with the stripper it's really, but it also, when you take out of it, so he meets with her. So what he does, he goes there. He actually goes into the trenches and he sees with his own eyes. He doesn't look at what the newspaper tells him. He doesn't look what other analysts tell him, what Wall Street tells him. He goes there and he sees it with his own eyes. And I think it's very important, where a lot of investors fall short, is not understanding what they're doing and really relying on other people to form their opinion. So what I learned from him in that scene is he went there and he saw with his own eyes how crazy it is, how all these empty houses and these subdivisions, And the scene, when you look at it, when he goes back to the airport, it's like, shorten the mark. Whatever you can buy, whatever you can find, shorten the mark as much as you can. Whoever he talks to, one of his analysts he talks to, But the lesson I learned from that was, like I said, you go there, you go in the trenches, you see with your own eyes, you build your own opinion,
I think it's so critical, especially nowadays. I think because with social media and all that, you can find your own echo chamber. So whatever opinion you have, you can find people to validate, reinforce that. And all of a sudden you're like, oh yeah, we're all on the same page, where you can find equally successful people that have a polar opposite opinion and trying to, find out your own theory of what's actually happening between them. I think it's important. Like I said, some people I think just get in the echo chamber and everybody agrees with them. Like you said, the yes men you're talking about before. It's not a good feedback.
I mean, look at the housing market. Everybody, interest rate goes up, and you look at LinkedIn, whatever, social media, Bloomberg, like all convinced housing is going to crash because interest rates go up. That means the mortgage is going to go up. People cannot afford houses. House price is going to drop. It's a given. It's like it has to happen, But so for me, I live in the Southeast. At the time, even in 2021, 2022, I saw how people still got multiple offers. People were crazy on buying and buying and buying. I'm like, I don't see it. Yes, interest rates went from 4% to 6%, but it didn't change anything. It really, like where in Florida, in South Alabama, it didn't change anything. Home values actually went up between 21 and 22 and up into early 2020. Yes, right now is a softening whatsoever, but we're at 8%. I mean, think about it. We went from 4 to 8 in no time, And so yes, at one point there will be an impact, but again, if you understand demand and supply and you see how these houses still trade and people try to buy them, there's still a high demand for it. Like, after the crash, and I'm pretty active on LinkedIn, so I was battling with several people on LinkedIn. We're like, oh no, it's going to crash. It's going to crash. I'm like,
I don't see it.
And looking back in hindsight, it didn't crash, and I still don't think it will crash. Yes. And here's the thing is, if I don't know the exact number, let's say home price on average went up 40%, even if they drop 10 or 20%, I mean, it's we're coming from a really high level. And people are like, oh, if it drops 10%, it's a crash. It's not, I don't know if that's really a crash if you go up 40 and then you drop 10, It's like, and there's so many other factors that go in, you build your own opinion, and like you said, these echo chambers and I don't think anything good comes out if you follow the herd, and if the herd says this is going to happen or that's going to happen, and especially when somebody tells you it's a given, for sure, this will happen.
Yeah.
If you're so convinced, you should sell everything you have and shorten mortgage-backed securities. That's what you should do. Because if you're so convinced this is going to happen, put all your money on it.
All in on Dogecoin.
Yeah. Dogecoin, I was wondering when you said that. I was wondering when you said that earlier. How many Dogecoin you have to have $2 million of Dogecoin? That's got to be $1 billion in Dogecoin, right? $1 billion Dogecoin, excuse me. Hey, so Marco, more recently in your real estate days, is there a funny story you can mention?
Funny story out of real estate?
Yeah.
I don't know, I have some sad stories, but funny
Those are
stories.
always enlightening.
Yeah. If it comes to you like at
Um,
3 in the morning, just call Richard, then fill him in, and we'll we'll add it to the show.
Yeah.
Here's the thing: I never had to call it through. I mean, I self-manage a lot of my properties.
Yeah.
I mean, I don't work anymore, so I have the time, and also the model I chose. And maybe a quick comment about single family. I think a lot of people single family has a bad rap. You know, a lot of people look down and like, oh, you cannot scale up, and single family a lot of issues and this and that, and you have to buy multifamily and to scale up, and you spread your risk and whatsoever. And I agree to some extent, but the way I look at it, single family is I look at it from an institutional perspective, and I think Blackstone showed that you can scale up in single family. I mean, at one point, these guys
Sure.
owned 50,000 single family homes in the United States, you know, and I'm
Yeah.
not a Blackstone, but I use the Blackstone approach on how they do it because what they did is they bought newer homes. They didn't
Hmm.
buy those 40s, 50s built homes with old piping, old electric, and all these little issues and whatsoever. And a lot of investors, they get carried away. They see these homes like, oh, I can buy this house for $100,000 and I can rent it for $1,300. That's a phenomenal return. Let's buy those. Yeah. But when they look at it at the end of the year, all the profit was eaten up by all these little repairs. Plus, the
Hmm.
quality of tenants is not as good. It's the lower you go in the price range, the worse the quality of tenants gets. So that's where a lot of people, I think, where single family gets a bad rep, but I think one of the reasons I could self manage a lot is because all I buy is newer properties that need less maintenance, and I do a lot of preventive maintenance up front before I rent them.
Hmm.
Um, yeah.
Good.
But I'm thinking about a funny story. Man, there's so many. I'm laughing all the time. I can't think of a funny story.
Yeah, we
Um,
can circle back to
I
that.
was laughing. I mean, I don't want to put shade on Grant Cardone. I like Grant Cardone, but I was reading yesterday. I was reading a post from him where he gave his 5, 6 guidance point for the real estate market right now, and his number 2 was embrace the down portfolio. So, so,
What
so
was the
it's
number
it's
two?
that was like it's like okay, the same guy who said 18 months, put all your money in multifamily because that's the way to go. And then 18 months later, he tells you the market. And I have no idea. Multifamily chopped out 20% valuation. The same guy tells you, yeah, you put all your money in multifamily. You know, it's like, okay, wait a minute, you told me to put all my money 18 months ago, and now as a drop, you tell me again, put all my money, and at the same time, you're saying embrace the down portfolio. So I'm like,
Embrace the
it's a
down
bit of,
portfolio.
yeah,
Okay.
it's a little bit of a stretch.
Embrace
Hmm.
whatever I'm selling right
So,
now.
so I got a good
Yeah.
chuckle out of that yesterday when I read that. So, anyways, but
Think you'd be in sales or something. Well, Mark, where are you today on your journey? Like you mentioned, obviously going to single family, then smaller multifamily, then larger multifamily, doing syndication. It sounds like, and partner with people now. So, kind of where are you now, and where are you looking to go in the future? Are you still picking up
yeah,
just
I
multifamily at
don't
this
do
point? Or?
Yeah,
Huh?
I don't do syndication. Never really did syndications. What I did was joint ventures. So we focused on the 30, 40 unit multi-family in the
Hmm. Hmm.
southeast. And when we started, you could still buy those for $1 million, $2 million. And that's what we did when we did multifamily. And some of it, like the 12 plex, I did by myself. And I love multifamily. It's just for me right now, it's just a lot of noise in it. And I'm kind of put the brakes on it. Probably
Hmm.
definitely will get back into it, but kind of see where things go with interest rates and cap rates and kind of things. I do single family still. I'm very opportunistic selective. So if I find a good opportunity, I buy it. I sold a few of my houses where I felt like it's not really what I want to own long
Hmm.
term, where I felt like it appreciate quite a bit. So it's a good time to get out. So I'm very selective buying house here and there. I'm actually I'm right now in the process of kind of building a good base and kind of I'm actually going to give my house to property managers right now, so I will not do the self-managing so much anymore. And the plan is to move to Cabo probably next 3 months. So I will
Nice.
actually live there permanently, and we'll start a real estate business in Cabo, Mexico. So that's
Wow.
that's the current game plan.
We'll definitely want to hear more about that down the road. So very cool. Very cool. Nice. Nice.
Yeah, it's a place I really like. I really enjoyed there. I don't know if you've ever been there, but it's a very vibrant place. There's a lot of activity. There's homes built everywhere. There's people from all over the world coming there for businesses, investments, and whatsoever. So it's got a lot of good friends there. So it's a place I really enjoy being. So I like Fort Myers, and that will always be um, part of the plan. Still keep a place in Fort Myers, but ultimately I will try something new in Cabo.
Yeah. Very nice. So, Marco, what advice would you give to somebody who's considering making a path change?
My advice is to stay in your corporate job, okay, and build these things, whatever you want to do, your side hustle, start investing, do that on the side. There's a lot of gurus out there that say, burn the ships, quit your job, go all in, and I don't agree on that. I mean, first of all, if you make a six-figure income salary wise, you just don't walk away from it. It's just not, it's without having some supporting cash flow coming in whatsoever. So my advice would be to stay in your job, still try to advance in career. I mean, one of my at one point when I got into real estate, I was still advancing my career, working hard, trying to get promotions, try to work with another company, get a higher salary. Because for me was the more salary I make, the more houses I can buy.
Right.
The quicker I can save up for the next house. And the more houses I can buy, the sooner I can retire from my corporate job.
Right.
So that was kind of my thought process. So I was still working hard. I was still changing jobs for better salary. So I think you shouldn't neglect your career and still try to advance it and try to generate more income, but not generate more income to buy more things, to live in a bigger house, or buy a nicer car. Take that money and invest it in cash flowing assets, whatever that is, multifamily, single family, storage, whatever it is. But be consistent with it. Take that money, anything additional money you make, and put that in cash flow assets and build up that cash flow to at one point you're going to feel comfortable to leave corporate world. I think that's the strategy I would use.
So that's critical great. On that because people just get lifestyle creep, right? I mean, they get a promotion, get the raise, they get, like I said, the newer car, the bigger house, and they're just broke at different levels. It has to go up there still.
This is the whole concept of corporate. It's the golden handcuffs. It's like right. it's like you okay, whatever. I'm a controller, so now I'm a VP or whatever. So now I'm making O2, but now I'm a VP. I cannot drive that Camry anymore. So now I got to drive a nice Cadillac or a nice. Lexus or something, so because I gotta represent them. I'm the VP, and I cannot live in this neighborhood anymore. So now I gotta live in that neighborhood, So that's where people get carried away. As they increase their salary, as they advance their career, they think they have to adjust their lifestyle accordingly. And then the next thing you know, it's like, okay, I'm making $30,000 more, but by the end of the month, I still have the same money.
Because their expenses went way up.
Right. Yeah. Because in the end, there's one of the things that really drives me too. It's not about how much you make, and it's not about how much you save. It's about how much you keep. That's right. the what's really the deciding concept. It's like okay, yes, you instead of $200,000 now you're making $300,000 salary. Okay, that's great. But how much do you keep of that, or also a lot of people get hung up by saving, it's like, I got to be very frugal, I got to save this and that, but yeah, you got to look at how much you keep. If you make only $60,000 and you're very frugal, you can be as frugal as much you want, you're not going to save enough to build a portfolio, to build a new lifestyle or whatsoever. It's not going to be enough, between you still got to eat something, you still got to live somewhere, by the end of the day, you can save as much as you want, but if your top line is not increasing, you're not going
to. It's almost a difference between.
By the end of the day, it's all about how much you keep.
It's almost the
having
difference
that
between
space.
Dave Ramsey approach and a Grant Cardone approach, right? Dave has, save yourself no Starbucks, no coffee, and you'll eventually be able to retire. And Grant's like, I leave the lights on at home and I just make more money because you can always grow
Yeah.
like you said, the top line you can grow unlimited, right? You can only save so much money. You can only cut so many expenses out of your budget. I mean, not to be reckless on either side of it, but I mean that's it. One has much more potential, exponentially higher leverage.
This is one of the moments where it clicked in my head too. Is like there's no, like you said, there's no limitation on how much you can grow your top line. There's a limitation on how much you can save, and you will never be able to save more than 100%. I mean, probably even less than that, but that's the best you can do. Grow your income. You can grow your income 200, 300, 400%. There's no
Yep.
limitation on growing your income, your top line.
Yep.
So I agree 100%. And
Yeah. Well, Marco, what's
but I like the analogy, something between Dave Ramsey and Grant Cardone. I think
It's fun.
I'm gonna keep that. That's I like this.
Well, Marco, what's the best way for our listeners to reach out, learn more about what you have going on?
Probably LinkedIn. I'm very active on LinkedIn. I post every day. Have a little bit of a following there on LinkedIn. I post about my journey, about financial freedom. How do I become financial freedom? What do I do? So yeah, I'm very active on LinkedIn. It's yeah, that's probably the best way to reach out to me.
Okay. Well, very good. Well, Marco, we really enjoyed the conversation today and want to wish you continued success on your endeavors.
Absolutely, and I appreciate the invitation. I enjoyed it a lot. It was great talking to you guys.
Absolutely. Thank you, Marco, for being on. We also want to thank our listeners. Please continue to give us a 5-star rating so we can bring you more great content like our show today with Marco Pfeiffer. And want to remind everybody about a couple important things that Park Capital Partners has going on. First, we have the Park Capital Partners Value Add Fund, which is a 506c fund open today to accredited investors. Second, we have the Park Capital Partners Foundation, which is a 501(c) nonprofit that Bill and I created as another way that we give back. The way that works quickly is first, we fund its operations, so all the money donated goes to do its best work, which is to help others. Second, we donate personally. Third, we donate corporately. And finally, when investors invest with us in one of our projects, we make a donation to honor that investor to a pre-selected list of 15 different charities that the investor gets to pick. So thank you, folks. Please reach out to Bill and myself, parkcapitalpartnersllc.com, parkcapitalpartnersllc.com. And remember, folks, the road less traveled may be calling you. We recommend that you listen and take action. Thanks for joining.